Hey, welcome to the exchange. Let's look at Snowflake. What are they actually worth right now, potentially where they're trying to go in the future? So this is Snowflake's chart. This last 3 months, and you're going to see it's basically a gradual decline in the last 3 months. I mean, growth equity stocks have been absolutely hit by both Omicron and the Ukraine crisis. Really, what happened though, the big drop off you had was that 30% sell off March 1st, March 2nd timeframe. That was their Q4 earnings release, and they absolutely got killed. And they actually beat top line and bottom line, but the actual forward guidance was pretty bad. It wasn't extremely negative, but it was just like overall, this hyper growth trend is kind of slowing down a little bit for Snowflake. That's kind of what drove the stock much lower, but. Pull up this here. This is their Q4 basically earnings presentation they have. So it kind of shows their time as a company, kind of where they're at. So from 2014, basically cloud data warehousing to 2020 and beyond, trying to basically make this almost like platform as a service, data cloud. We can basically come in, design, integrate, launch the various dashboards and everything else too, all the various integrations and connectors and whatnot. That's what they're trying to go to. They're not quite there yet, but they're making those strides toward that direction. So this is really how they view their market share right now. So looking at the overall data warehousing kind of market, it's $14 billion. The data cloud overall is saying $90 billion and potentially much bigger. And that's kind of what they're hinting at right here, potentially for their data cloud kind of philosophy. But I mean, growth for them, it's had strong growth, but the question is where do they go from here? How do they keep growing? Because they're having a strong saturation point across all the Fortune 500 companies, which we'll see that later overall. So this is their Q4 financial highlights. Again, 102% year-over-year revenue growth. I mean, absolutely fantastic. Net retention revenue is almost like recurring revenue of retention. It's 178% growth, which is fantastic there. So companies are buying in, rebuying in, buying larger and larger stakes overall. $1 million plus customers, 184. Gross margin overall, 75%. This gross margin is adjusted EBITDA basis was actually about 70%, which is still a strong, healthy growth margin for basically a software company overall. So they are not a SaaS model. So this is what they stress a lot, which is very true. So SaaS model, think of like Netflix. It's that recurring subscription revenue. It's very timely. You kind of know when it's going to actually be utilized, how much it's going to be forecasted, etc. They are actually almost like a credit model. It's almost like buying like gift cards. So basically what you're doing there with Snowflake is you're buying compute credits. So you can use those credits between now and usually about a year out or so. So anytime next year or so, you can use those compute credits, which is totally fine, but it makes your revenue a little bit more lumpy than other SaaS companies out there. So it's a little bit different there too, and it's hard to understand a little bit too. So this is their overall market presence, basically by geography. And you see right here, they're very heavily dominated in the Americas region. And also a little bit of Eastern, Middle East, Asia, Asia Pacific right there, not that much. I mean, the good news here is room for growth is absolutely, it's a massive room there, at least internationally. Domestically, it's starting to get a little tapped out. They're about half the Fortune 500 companies. So, they have strong market share there. The question is, how do they either grow the wallet size of these accounts or potentially find new accounts to go after? So international growth will be very, very important for them. So this is the slide, this next one. This is the slide that actually killed the actual stock last week. This is really caused that 30% growth. And the big number we're looking at here is basically their forward guidance. This is year-over-year product revenue growth, which is their main revenue driver. So you see from fiscal year 2020 to fiscal year 2022, 164%, 120%, 106%. 66%, it's not a surprise that 66% right there, but really what they're expecting is 80s, 90% plus. This is really showing, hey, the market's slowing down. They're having harder sells. They are a very premium, high-priced product there. There's also a lot of competitors out there, whether it's Amazon or Microsoft or anybody else out there that are actually affecting them overall. Operating income, this is adjusted EBITDA basis. They're saying their operating income going to be a 1% basically gain this fiscal year. And free cash flow will be positive. It was positive last, based on adjusted EBITDA basis, it was positive last fiscal year too. So it's going to basically increase that free cash flow overall. But let's dive into a little valuation real fast and see how the actual company is operating and what they're actually worth, in my opinion. So this little model I built up for Snowflake real fast. And this is basically the first top line there, obviously revenue. It's about 95% product revenue. They do have a services line. It's about 5% of the revenue. It's I don't know how profitable it is, but it's not much of a big revenue hit overall. So you can kind of somewhat not ignore it, but you can definitely factor it in. That's why you see revenue growth rate. The previous midpoint guidance was 66%. I'm saying 64%, including the services revenue overall. Roughly a $2 billion target amount for this fiscal year, which they should hit. Again, but look at the growth rates between 2022 and 2023. It is a large drop off, and that's really kind of a shock to investors. They thought that'd be 90%, 90% plus kind of growth rate going forward for 2023. But it's slowing down too. And they're having issues with both, again, with overall market penetration. They're getting pretty saturated, at least in the domestic U.S. market. That's really what we're trying to shift right now. Is really looking at government sales, potentially the U.S. government or even foreign governments overall. It's almost like a reverse Palantir, whereas Palantir is trying to go from government sector to the actual civilian sector. Snowflake actually might be trying to go into the actual the actual basically like private sector to the actual government sector overall. They're also looking at two potentially help increase the growth rate. So right now, Snowflake is looking at only handles basically structured or semi-structured data, which basically means like your SQL databases, your .xml kind of databases, which are pretty heavily structured. Now, unstructured data is almost like video, audio files, kind of that just very, very large overall like addressable markets there. And if they can address that, I mean, it's a huge, huge obviously market growth potential for them, which could help grow the actual overall revenue and kind of their overall marketability of some of these customers. Because by far, in a large, is the actual unstructured data space is much bigger than the actual structured data space, but it's just growing from both consumers and from corporations overall. Looking at cost of revenues, not that surprising. Gross profits are all pretty healthy. I mean, imagine like a software company. They're not a SaaS company, but they are a software company. 60% plus gross profit. I mean, very healthy. It's going to increase as it get more efficient. They gain economies of scale as it get bigger and bigger, both domestically and internationally. Again, just like other growth companies in the software space, the OpEx is really what kills them a little bit. So looking at, I did right here is basically sales, marketing, general administrative, research and development. Also look at the actual growth rates of those actual expenses as well as the percent of revenue. So you can see in 2022, sales and marketing, 60% of overall revenue. I mean, just massive numbers. Not sustainable, but again, talking about that market penetration, saturation. I mean, it's something they have to do in order to get their name out there and make sure get those initial contracts won to help kind of basically like win for their brand. G&A, not a massive number this last fiscal year, but it's still a large number overall. The growth rate is not going to be as aggressive as potentially other areas. R&D is the one where they have to keep spending there. I think it's going to maintain a pretty high growth rate. Also, a pretty high percent of revenue growth rate too, or percent of revenue overall. Because you think about going from the private sector to the government sector, there's all kinds of integration issues, security issues there they have to do. Also, going from like structured data, like SQL databases, to unstructured data is going to be a lot more challenging too. And it's going to require a heavy R&D spend to really kind of grow their platform, make sure their platform is compatible with all those various data sources, and also the integrations in general. Again, operating income, it's pretty ugly. I mean, 2022 is pretty bad. I'm saying 2023 on a operating income basis about negative 700 million. It's not terrible. It's not great though. Obviously, operating margins are going to be improving overall. The big fear is, again, just like most SaaS companies, most software companies, is if the revenue drops off or even flatlines. I mean, it could kill them on the bottom line down here. But again, not much interest on their debt overall. Net operating income or non-operating income. They have some investments out there. It's not much though, but it adds a little bit to overall value. Tax bases, again, not profitable, so they almost have no taxes. I'm saying by 2026, fiscal year 2026, they're going to have basically a net income of 500 million. And I'm saying really the ramp off period, the launch off period on a bottom line basis for net income, this isn't like on a GAAP basis, is basically 2027, which I'm really seeing that $1.5 billion of net income, which is, again, massive numbers right there. CapEx is mostly down to the actual, the PP&E, basically buildings, acquisitions overall, growing their footprint, growing their offices, and everything else too. Depreciation and amortization on the actual raw buildings, it's not much overall. So what I did right here, basically, this is a DCF model, discounted cash flow model. I took their operating income, called their EBIT, basically less taxes, plus the D&A, less CapEx, less the net working capital change. And basically what you get here is the free cash flows to the firm, basically broken up by fiscal year, and then the very bottom, or the very bottom right here, is the exit multiple, basically a terminal value multiple, basically it's taking the actual long-term perpetuity of the actual growth rate of the company from now until, basically from 2027 until infinity, what it actually is worth. So I did a Gordon growth model there, which you don't have to worry about that. Just know it came out to 73,478. So basically what it's saying is we're going to burn cash from now until 2026, and in 2027, the perpetuity model is going to take in place, and we're basically going to receive $73 billion in cash in 2027. But of course, if you discount that backwards, that's all I did right here. You get an enterprise value of $46 billion. I assumed a cash balance of basically $4 billion. Conservative estimate, it might be a little bit more, it might be a little bit less. I said debt right now at $2.5 billion in 2027 overall. So I mean, it's not much, but it could change. Equity value $47 billion. Shares outstanding 306. I think diluted shares overall might be as high as 359 million. And that basically gives me a valuation of $156.03 today. So again, it's a little bit below where they're at right now, but think about the actual changes that could be coming in the future to help kind of increase the valuation and for the growth going forward. So that's really a little bit of downside news. Like, what's the actual upside? What's potential chance for either a rebound or recovery overall, and kind of where they're trying to go to? So what we're trying to do is make this like idea of a data cloud. When the data cloud is basically it's a data warehousing layer built on top and with integrations to basically visualizations, dashboards, etc. And that's why, if you look at here, they acquired this company called Streamlit, which is basically a basic database apps. It's almost like if you're a middleweight developer, a middleweight Python developer, you make very, very fast dashboards based on these queries from Snowflake queries. You basically build very, very quickly and make these beautiful dashboards overall. So this really acquisition shows you they're trying to get really in that kind of like the data visualization space / data transfer space, because what they have right now is they really have this great brand, great asset, but it's hard. I mean, it's a lot of competitors out there, whether it's Microsoft, Google, or even Amazon overall. So they know, hey, long term, that's not going to be a long term play. So they need to actually basically get a larger data platform, larger visualization platform, and make it much easier for data scientists to actually do work on their platform at a cheaper cost overall. But if they do that well, I mean, it'll make it very sticky, make the overall retention go up even higher potentially. Also, they might be able to charge more money in the long term potentially. Now, what's the downside risk here? So if you look at this is basically from Snowflake's website, it's kind of how they view their workloads. And what you see is kind of the full spectrum of workloads, which it's built upon Google Cloud, AWS, Microsoft Azure, and all these things they're doing on here are basic extensions of those platforms. They basically run on those platforms behind the scenes. But Google, AWS, and Azure, they have their own competitive platforms, basically counter Snowflake. They actually could offer similar things. So if Snowflake can't differentiate themselves long term potentially by adding these visualization dashboards and everything else in like 2026, 2027 time frame potentially, or even earlier, I mean, they're going to have a trouble too. Like either they have to drop their margins down and basically drop the price of the actual compute layers for Snowflake's overall compute tokens down, or potentially, I mean, they could be either lose market share or even possibly go to business as the worst case scenario, or possibly get acquired too. I don't think it's going to happen though. I think they have enough differentiation right now that they're going to be absolutely fine in the short term. But long term, they have to be, basically build on top of this platform, keep adding features, keep adding new things, and also dropping the cost down though too. Another thing to mention is so all these cloud providers all built on compute platforms, obviously, and compute's getting more and more efficient. So basically what happens is when you buy a Snowflake token or a Snowflake basically overall token, you basically buy a layer or a time of compute basically. You basically buy compute hours. So as they get more efficient, let's say you're a company and you use 100 compute hours per month, and that's basically what you pay Snowflake based on their prorated agreement or whatever else it might be. But as those VMs and everything else gets more efficient, you might only need 80 or 70 compute hours. So as time goes forward, I mean, they're going to actually be losing money potentially if they can't keep gaining customers in the long run, as these VMs and everything else and CPUs and GPUs get more and more efficient overall. That's kind of the big fear they have right now. That's what they're trying to get into more of the actual government, potentially government sales or potentially unstructured data sales, and that's why they're trying to build some kind of data cloud overall. Because if they don't do that, pivot, they know, hey, 3, 4, or 5 years from now, it could be very, very bad for them, or they might become a more niche player and won't have that broad spectrum, kind of that broad growth opportunities they have right now. Which we'll see what happens. I mean, it's definitely an interesting story, and we'll see what's going to happen with the overall stock and everything else going forward. Hey, so let me know your thoughts on Snowflake stock. Also, like the video, hit the like button down below, hit subscribe to the overall channel. Kind of right now I'm doing a mixture of kind of really stock videos and Ukraine crisis videos, because they're all obviously very, basically connected right now. I mean, it is a very dynamic market. Things are happening very fast. But yeah, definitely let me know your thoughts, and have a good day.